Hey everyone, and welcome to this explainer. Looking at the global economy right now in May 2026, it's literally a tale of two economies. On one hand, we've got this explosive high-tech digital supercycle that is just smashing every valuation record in the books. But on the flip side, the physical economy, the industries that actually build, fuel, and move our daily lives, they're facing a totally grueling, margin-crushing squeeze. So today, we're going to dig into the data behind these two seemingly disconnected worlds, and more importantly, find the hidden threads that actually tie them together.
Okay, let's dive into this and lay out our roadmap. We're going to start by unpacking this 2026 economic divide. Then we'll ride the wave of the AI semiconductor supercycle before sharply pivoting to the heavy industry squeeze. After that, we'll expose some hidden supply chain choke points and wrap up with how traditional industries are optimizing just to survive.
All right, let's jump right into part one, the 2026 economic divide, or what we're calling the boom versus the squeeze.
It's a really stark contrast. In the digital space, it's absolute euphoria. Thanks to the massive build-out of AI infrastructure, tech valuations are skyrocketing. But then you look over at traditional manufacturing, chemical production, and heavy commodities, and the reality is completely different. They're battling massive global oversupply. They're having to aggressively close down capacity just to fight for basic profitability. It's this wild macroeconomic paradox, and it's happening at the exact same time.
Let's move to the digital side of things and see how this builds. Section 2, the AI semiconductor supercycle.
AI infrastructure is no longer just a trend or a buzzword, it's the absolute bedrock of early 2026 industry growth. According to Rebound Electronics, we're way past the days of cyclical peaks and valleys. Massive data center expansions and this relentless hunger for high-bandwidth memory, they are structural drivers now. They've fundamentally redefined the entire growth trajectory of the semiconductor sector.
To really anchor the scale of this boom, wrap your head around this number, $791.7 billion. That is the massive global semiconductor sales figure we hit back in 2025. It rebounded incredibly hard, and it's projected to just keep expanding through the rest of the decade. We are literally talking about a near trillion-dollar industry forming the backbone of the global digital transition.
And the financial gravity of the key players is just staggering. By Q1 2026, NVIDIA was sitting at a massive $4.38 trillion market cap. TSMC is at $1.75 trillion and Broadcom at $1.52 trillion. Honestly, these aren't even just companies anymore. They're foundational pillars of the new global economy. And their valuations are completely untethered from the sluggishness we're seeing in other parts of the world.
Which brings us to the second half of our story, Section 3, the heavy industry squeeze.
While those tech giants are counting their trillions, traditional sectors like petrochemicals and heavy materials are staring down a very different reality. Subdued global demand combined with massive overcapacity, mostly driven by aggressive capacity additions over in Asia over the last few years, has put an immense amount of downward pressure on North American and European chemical producers.
S&P Global Chemicals really hit the nail on the head here. They noted that prolonged weak demand and global oversupply across many chemical value chains are, without a doubt, a key challenge for 2026. To put that into perspective, earnings expectations took a huge hit, with 2025 EBITDA dropping roughly 50% on average compared to earlier forecasts. For these legacy companies, 2026 is absolutely not about growth. It's about sheer survival, cutting costs, and permanently shutting down older, less efficient facilities.
Now, what's really interesting about this data from the World Bank is the vast disparity hidden inside the commodity markets themselves. You see, while agriculture and baseline energy are seeing pretty muted recoveries or even slight declines, the metals sector, and specifically precious metals, is telling a completely different story. Check this out, an 84% surge. The precious metals index absolutely skyrocketed 84% between the first quarter of 2025 and the first quarter of 2026. Why? Well, it's because the physical market is currently gripped by extraordinary geopolitical volatility. When global stress escalates, the physical economy reacts violently. It drives this wild speculative fervor into safe haven assets, even while base commodities are completely bogged down by oversupply. And that leads us to a really crucial intersection, Section 4. Hidden supply chain choke points. This is where these two completely disconnected worlds actually collide.
Because here's the thing, despite their soaring valuations, the digital giants rely entirely on the physical world.
Market insights from Q1 2026 show exactly how regional geopolitical conflicts, especially in the Middle East, create massive ripple effects. We're talking about energy price volatility directly threatening those highly energy-intensive semiconductor fabrication plants. We're talking about major disruptions at global aviation hubs that threaten the air freight of all these high-value electronics.
But perhaps the most fascinating and fragile dependency is helium. Helium is the hidden choke point of 2026. It's a non-renewable gas, heavily concentrated in the Gulf region, and it is absolutely vital for advanced semiconductor EUV lithography, wafer cooling, and plasma etching. And the kicker? There is no scalable substitute, meaning the entire multi-trillion-dollar advanced AI chip market is tethered to the incredibly fragile supply of this highly constrained physical resource. It is literally the perfect collision of our two economies.
So how do you handle that? Let's bring this down to the factory floor. Section 5, Optimizing to Survive. When you can't control external markets, you've got to control your internal operations. Right now, manufacturing managers are aggressively pushing KPIs like OEE, or Overall Equipment Effectiveness. Simply put, it multiplies your availability, performance, and quality into a single metric. If external material costs are up and order volumes are down, maximizing your OEE is quite literally the only lever you have left to pull to protect those shrinking profit margins.
So the crucial point becomes predicting exactly when things are going to break. In heavy industries like open-pit mining, for example, they rely heavily on MTBF, which is mean time between failures. This tracks the average operating hours between one breakdown and the next. Because in that world, every single hour a massive mining truck is out of commission, capital is just bleeding away.
And here's where our explainer comes full circle. How are these traditional, deeply squeezed industries improving their machine failure rates? By using the exact same technology that's driving the tech supercycle, artificial intelligence. Heavy industries are rapidly moving away from basic, simple correlations. Instead, they're scooping up vast amounts of historical failure data, training baseline decision trees, and deploying advanced random forest ensemble models. Why? To predict exactly when a machine will fail before it actually happens, drastically cutting down maintenance costs.
So we've explored a world split entirely in two. On one side, the astronomical heights of the AI semiconductor boom. On the other, the ground-level struggle of chemical oversupply and heavy industry optimization. Yet through fragile supply chain choke points and the integration of AI right on the factory floor, these worlds remain deeply, inextricably connected. Which leaves us with one final, critical thought to reflect on today. In this deeply divided 2026 economy, is your industry riding the supercycle, or are you just optimizing to survive?